Why is TLT about to pop in 2023? Half of the world is in recession, the other half keeps hiking rates. U.S. jobless claims mysteriously surge on data revision. U.S. jobs revised sharply lower too. Europe surprisingly enters a recession on data revision. Like I said, Germany's recession will spread through Europe. That's weeks ago. 9 European countries saw GDP decline last quarter. Wednesday, the Bank of Canada follows Australia, hiked its overnight rate to 4.75%, the highest rate since 2000. It surprised the majority of people that expected the central bank to extend its pause and remain unchanged at 4.5%. But nope, they want to lock in this recession. Meanwhile, China's state-run banks cut deposit interest rates and are talking about stimulus to stimulate the sluggish economy that's already in a recession just like Europe, which soon will be our turn. Why TLT is about to pop in 2023. In my opinion, I will explain it all right after this.
How you like that? How you like that? Nah, look at you, now look at me. Look at you.
Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video. Because you're already a success, it is done when you join the Audacious Money Witch Club. This video is brought to you by my website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? The Bank of Canada said that the overall excess demand in the economy looks to be more persistent than anticipated. The bank said in its rate statement, Governing Council decided to increase the policy interest rate, reflecting our view that monetary policy was not sufficiently restrictive to bring supply and demand back into balance and return inflation sustainably to the 2% target. The bank also said that it will be evaluating whether the evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the inflation target, and added that it remains resolute in its commitment to restoring price stability for Canadians. Bank continues to expect CPI inflation to ease to around 3% in the summer as lower energy prices feed through and last year's large price gains fall out of the yearly data. However, with 3-month measures of core inflation running in the 3 to 4% range for several months and excess demand persisting, concerns have increased that CPI inflation could get stuck materially above the 2% target. The labor market remains tight. Higher immigration and participation rates are expanding the supply of workers, but new workers have been quickly hired, reflecting continued strong demand for labor. Overall, excess demand in the economy looks to be more persistent than anticipated. Demand for services continue to rebound. In addition, spending on interest-sensitive goods increased, and more recently, housing market activity has picked up. Since declaring a conditional pause in January, policymakers have warned that further rate increases may be necessary. And while some Canadians are feeling the pinch of steeper borrowing costs, the bank's move from the sidelines suggests officials are worried that economic momentum won't slow enough without another hike. Monetary policy was not sufficiently restrictive to bring supply and demand into balance and return inflation sustainably to the 2% target, the bank said, citing an accumulative of evidence that includes stronger than expected first quarter output growth, an uptick in inflation, and a rebound in housing market activity. The move follows a surprise 25 basis point boost Tuesday by the Reserve Bank of Australia. The Bank of Canada was the first and only G7 central bank to pause its hiking cycle. Now it's changed its mind, conceding that higher borrowing costs are still required to bring inflation to heel in an economy that's proving more resilient than anticipated. Understandably, the central bank also removed the April language about being prepared to raise rates further if needed. Bank of Canada Chief Macklem and his officials pointed to elevated 3-month moving measures of underlying price pressures as a key reason for their move. What about the oil and gas price? It seems to be the same as last year. All the rate hikes doesn't mean anything if gas price stays the same. We know that the stock market is up. Investors are starting to turn bullish now because of prices, not because of macro, of course. So the question is, what about the bond market and oil price? Are they just keep sitting tight while the rest of kids are having fun? TLT will only go up if oil price drops. Let's talk about why oil price will drop in 2023. Keywords: Russian and Saudis. OPEC plus to Saudis, you keep cutting, we'll keep producing. For the benefit of the rolling cameras, Saudi Energy Minister Prince Abdulaziz bin Salman triumphantly declared that the rest of OPEC plus will keep to promised oil cuts till 2024. While the kingdom itself will slash an additional 1 million barrels per day next month. The OPEC Plus delegates around him were smiling too, probably because they knew they'd be producing while the Saudis were vowing to double down on cuts. Slower than anticipated oil demand in top importer China fears of a global recession. Enter OPEC Plus and its production cuts. Oil revenue is the lifeblood of the economies in OPEC, or the Organization of the Petroleum Exporting Countries, a 13-member Saud-led group whose main objective is to be the price setter of the commodity. 10 other oil-producing states, including Russia, that aren't OPEC members, have also been keeping their output closely in line with the groups for the sake of the price. The 23-nation alliance is collectively known as OPEC+. For co-OPEC members like Kuwait and Iraq, more than 90% of all their revenue comes from oil. In the United Arab Emirates, oil accounts for 13% of exports and 30% of GDP. In Saudi Arabia, OPEC's largest member, oil accounts for 70% of total export value and 53% of government revenue. That's not all. Media report says the Saudis need at least $500 billion, or as much as $8.5 trillion, to successfully diversify their economy away from oil. Thus, it's easy to see why OPEC, particularly Saudi Arabia, which needs a barrel at more than $80 to realize its ambitious plans, would go to any extent to get the price it wants. OPEC's answer to lower oil prices has always been production cuts that deprive the market of millions of barrels of crude per day, to create an artificial supply squeeze that ultimately pushes the market higher. But in a global economy, short sellers, or those betting on lower oil prices, have won more often than OPEC, despite world oil supplies being at one of their lowest in years. On several occasions over the past 4 years, the Saudi prince has gloated at his ability to produce this so-called ouch, typically each time after he announced a substantial and unexpected production cut. To the detriment of the prince, however, the pain has often moved quickly from the short sellers back to OPEC, which had seen prices drop despite the cuts. It was this setting that the latest OPEC meeting came into. Some 2 weeks before the event, the Saudi energy minister again warned the short sellers in oil to watch out, triggering speculation that he was planning another production cut. Tensions between Saudi Arabia and Russia were real, and Moscow refused to add meaningfully to the 500,000 barrels it claimed to be cutting on a daily basis, which no one else in OPEC Plus believed anyway, but had to pretend was true to paint a picture of solidarity within the alliance. What everyone knew to be true, of course, was that to fund its war against Ukraine, Russia would sell every drop of oil it could at any price within the $60 per barrel limit set by G7. Ask the Indian and Chinese buyers for proof of that. OPEC Plus's production targets are typically decided by Audacious himself and his half-brother and Crown Prince Mohammed bin Salman, the chief architect of the grandiose Saudi economic remaking plan. The targets are then dressed up as OPEC Plus decisions, often without consulting with other group members. The only real thing we can see is the Saudi pledge to drop their production to 9 million barrels daily in July, after all cuts. That's 3 million below the US production of 12 million barrels. If the Saudis don't get prices up as much as they want, they'll drop production to 8 million next. That will be 4 million short of US output. The Russians will continue to max out at 9 to 10 million barrels. So who's losing market shares here? If not the Saudis. The reality of this situation is the rest of OPEC Plus is telling the Saudis, you keep cutting, we'll keep producing. As oil demand keeps decreasing because of EV, oil price will drop lower, especially when the West starts producing it again. My book, Believe You're Worthy. You are such a good boy for watching my video right till the end. Bye.